You are watching your screen, and suddenly, a massive green candle erupts. The price is climbing by the second. The instinct is immediate. You have to get in before you miss the run. But by the time that candle dominates your monitor and the volume bars spike, the optimal window for entry is already closed. Buying into that aggressive expansion traps the retail trader. They are acquiring positions at the absolute peak of the move, absorbing maximum downside risk just as the momentum exhausts itself. There is a persistent myth that these violent price movements are random anomalies, unpredictable explosions that you can only react to and chase. Stop looking at the top of the candle. To understand where this momentum comes from, we need to stop reacting to the breakout and investigate its structural origins. We have to scrub the timeline backward, strip away the massive volume, remove the giant candles, and look at the days before the explosion.
Weeks prior to the breakout, the market conditions are dull. The price action is tightly compressed, moving completely sideways. It is exactly the kind of environment the average trader ignores. The mechanics of capturing institutional-level momentum are not found in the chaos of the price explosion. The setup is hidden entirely within these ignored, boring periods of extreme market compression. This compression is governed by a structural phenomenon known as volatility clustering. This chart illustrates the concept. Markets do not distribute volatility evenly. Calm periods group into flat baselines, while turbulent periods form massive spikes. Notice how the extreme expansions in the top section systematically originate directly from the flat periods of low volatility below. Amateurs scan feeds for high volume, hunting for active volatility while it's already occurring. Professional, systematic traders do the exact opposite. They scan the market for an absence of volatility. To build a sustainable trading model, you must stop pursuing active volatility and learn to accurately measure systemic compression. This is a Bloomberg terminal rendering of Bollinger Bands, the primary analytical tool used to translate raw, invisible market variance into visual evidence. To understand how this mathematical tool actually works, we need to strip away the complex interface and build it from the ground up. The foundation is a 20-period simple moving average, tracking the trend. Standard deviation then measures how far prices stray from that average, plotting two outer bands. These self-adjusting bands mechanically expand outward as variance increases and fiercely contract inward when price stabilizes. Bollinger Bands are not a predictive crystal ball. They are a real-time, dynamic boundary system that visualizes exactly where an asset sits in the volatility clustering cycle. When those bands reach their absolute maximum contraction, it creates a formation known as the squeeze. The squeeze is the visual fingerprint of the compression phase. It indicates a complete and total lack of directional momentum in the price. So, what is actually happening in the market microstructure when the chart appears entirely dead? A squeeze represents a transition phase of institutional accumulation. Smart money is quietly absorbing all available supply and demand at these levels, accumulating large positions without moving the broader price.
Notice that this absorption creates immense structural tension. Both retail buyers and short sellers are taking positions, but the lack of movement traps them together within an increasingly narrow corridor. It is the market equivalent of storing kinetic energy. The longer the price remains trapped in this tight range, the more potential energy accumulates. But there is a critical caveat. The squeeze guarantees that the market spring is coiling, but the formation itself is entirely directionally agnostic. It predicts the imminent return of massive momentum, but it does not tell you whether that momentum will resolve upward into a rally or downward into a crash. This introduces the volatility paradox. To safely capture extreme high volatility, an analytical trader must enter the market when volatility is at its absolute lowest. If you trade a highly volatile market, stop-loss orders must be placed far away from your entry price to avoid being triggered by normal, erratic swings. That wide distance equates to high capital exposure, limiting your upside. Now look at the squeeze. Because price variance is mathematically restricted by the contracted Bollinger Bands, the boundaries of risk are incredibly narrow. Defining risk with this level of precision allows the trader to deploy a significantly larger position size without increasing their total dollar amount at risk. Hunting for squeezes is an exercise in mathematical efficiency. You are optimizing your risk-to-reward ratio before the market explodes. Let's return to the market replay. We have identified the long, boring squeeze, and now we wait for the exact moment of regime change. The execution trigger is the break of structure. It occurs when a decisive price movement closes entirely outside the Bollinger Band's boundaries. But a structural break alone is incomplete. That candle must be validated by a massive, sudden surge in trading volume. This triggers a systemic cascade. Traders who position themselves in the wrong direction during the squeeze are suddenly trapped. They are forced to liquidate their positions to cover their losses, which mechanically accelerates the price even further in the direction of the breakout. Simultaneously, sidelined capital recognizes the new trend and floods into the market. This dual force of panic selling and aggressive buying completes the transition from a state of compression into a state of aggressive expansion. This volume-backed structural break provides the definitive proof. Institutional accumulation has ended, and the coiling spring has finally been released. Financial markets constantly breathe in and out. They transition from the chaos of wide expansion to the quiet tension of the squeeze, over and over again. The fatal error of the retail trader is instinctively chasing those massive green candles, reacting to momentum only after the optimal risk parameters have completely vanished. Attempting to buy into an already expanded market is like trying to board a high-speed train as it rockets past the platform. Analytical traders succeed because they wait patiently at the station. They use the quiet periods of compression to define their exact risk, and they take their seats well before the engine ever fires.